Okay, it's recording.
Good morning, everyone. It's my pleasure to call this meeting of the Sinking Point Commission to order. What I'd like to do is to turn it over to Christopher, make a public service announcement.
Thanks, Don. This is just a reminder to everyone here in the room and participating remotely that this meeting is being conducted in person at the Board of Pensions Conference Room, 16th floor of 2 Penn Center. Pursuant to Section 21-1503 of the Philadelphia Code, electronic recordings of this meeting will be made through the Microsoft Teams platform and by an audio recording. The recording will be made available to the public online at the Sinking Fund's website with no charge within 10 days. Please note that you consent to such recording by attending, participating, or speaking at such meeting. And with that, I will turn it back over to the chairman.
Thank you very much. The first order of business is the approval of the September 2025 Sinking Fund Commission transfer. Is there a motion?
Make a motion to approve.
Yes. I will second. All those in favor, please say aye.
Aye.
Okay. Opposed? Ayes have it. Before we go to the second order of business, we're going to ask Christopher if he has any comments that he'd like to make at this time.
No, I'll save something brief for the end. Where we're going to cover it, but the next agenda item will be the investment performance review, and then a discussion of one of our managers, Copeland. So I don't know if Alberto or Quaker wants to start on that. That's a quick one.
Hey, good morning. So I can kick off the discussion on Copeland, and then as we go through performance, Alberto can also just hit on some additional points. Oh goodness, did my thing freeze? Sorry about that. My Teams decided to freeze on me, so I'll just repeat my comments very quickly. So I'll walk through the Copeland memo, and then Alberto can go through any comments regarding Copeland and anything that was potentially missed as we go through the performance reports. So that would be the plan today. With that, if you could just bear with me for one moment, this is like a comedy of errors whenever someone from our team dials in on Teams. My laptop is frozen, so it's not a camera problem per se, but my laptop is frozen. But what I'm going to do is refer to the Copeland memo, and the Copeland memo will give a quick update on the strategy, the performance of the strategy, ultimately reasons for the underperformance that we've seen recently, and then recommendations around Copeland on a go-forward basis. To really cut to the conclusion, at this point, we're not recommending any action on Copeland, but we would recommend, as the market does rebound and the environment is more conducive to good performance for Copeland, we would then assess whether it would make sense to rebalance some of the monies away from Copeland. So that's the quick takeaway there as we think about Copeland and the broader discussion that we're about to have. So there are two items. There is a memo as well as a PowerPoint presentation on the Copeland SMID strategy. We'll start off with the memo, and please pause, stop me if you have any questions along the way. So the memo begins with a quick snapshot of Copeland and how much they represent in the portfolio. So 29.2 million, or 4% of the portfolio's assets. In July of this year, we transitioned from the Copeland small cap dividend growth strategy to the SMID strategy. What does that mean? Well, the small cap strategy focuses on stocks that have a market cap of 300 million to 2 billion. SMID basically means that you can now go higher up on the cap spectrum. So you can go up to that 10 billion mark, which would include mid cap stocks. So Copeland has a broader universe of stocks that it can invest in. And over the long term, it does mean that Copeland, in our opinion, can be a little bit more conservative when they have to be and a little bit more aggressive when they need to be. So, given the asset allocation of the portfolio, the fact we do not have alternatives, we view this as a prudent step for us in the allocation. Now, the SMID portfolio, as we will discuss momentarily, has gone through a period of underperformance relative to the index. Now, when we think about a manager like Copeland, this is an active manager. We have passive managers in the portfolio, and those passive managers replicate an index. They do just as well, just as bad as the index. We also have active managers, and those active managers, the goal is over the long term to see outperformance, but over the short term, we can see deviation or tracking error relative to the benchmark. And as we think about the SMID cap strategy, the Copeland SMID cap strategy, it has a very deliberate investment thesis of investing in companies with strong fundamentals, meaning that they have sustainable cash flows. They are committed to returning capital to shareholders through dividends. And you're looking at companies that are strong from a balance sheet cash flow standpoint. The other thing with Copeland is the concentrated nature of the portfolio. So the benchmark that they're compared against has 2,500 stocks, give or take. Copeland has around 60 stocks, meaning that when the portfolio's holdings are doing really, really well, you're going to see significant outperformance. When those same 40 to 60 stocks are dislocated from the market and not performing as well as expected, that's where you can expect to see some tracking error. So as we fast forward to the second page of the memo, which goes to the performance drivers for Copeland, what we'll see here are periods where the strategy will do very well, and then periods where the strategy would not perform so well. And when Copeland did outperform, we did see, for example, heightened volatility in the market, a significant sell-off in the market, and consumer sentiment, investor sentiment really gravitating towards stocks with strong balance sheets, reliable dividend growth, and so on. In this environment, we've seen more of a speculative rally where I think one example would be we can think of GameStop back in 2020. Alberto, I just took one of your examples, so apologies for that. You're going to have to come up with another name. But we can think of GameStop in 2020, where this was a stock that rallied tremendously. It should have not done as well as it did, but ultimately, because it was a meme stock and people were talking it up, it did exceptionally well. And in 2025, we've actually seen some of the risk on and the junk in the market rally tremendously. So lower quality stocks, higher beta stocks have rallied, and your quality stocks have not kept up. What does this all mean for a manager like Copeland? It basically means a manager like Copeland is really struggling versus the index right now. However, when there is a flight to quality in the market, meaning that when there is an eventual cooling off and a correction, we anticipate Copeland to do exceptionally well. There have been years like 2018, 2022, where this in fact happened for Copeland, and they were significantly above the benchmark. And given the asset allocation for this portfolio, where we don't have exposure to alternatives, we don't have exposure to lagged asset classes, we still feel that Copeland is a thoughtful defensive allocation in the portfolio. So we now conclude the memo by saying that Copeland, we would recommend revisiting them over the next 1 to 2 quarters from a performance standpoint, just to make sure that the investment thesis that they have continues to be something that we have conviction in. But ultimately, we're not recommending any action on Copeland. We also have a PowerPoint presentation, which is called the Copeland SMID Review. And let me pause and see if there are any questions regarding the memo before I quickly jump into the PowerPoint presentation.
Quick over, Alberto, in a down market, which yes, the thesis is that Copeland would do better, get more protection in a down market. How would they do compared to the index, for example? And I don't mean value index or growth index. I mean just the plain vanilla broad index, which would include growth, value, and fundamentals, right? So
Yes.
how would Copeland do compared to like a broad index in its area?
Yeah, absolutely. Absolutely, Fran. That's a great question, and we can point to a year like 2018. This was your lived experience in the performance book. So on page 12 of the September performance summary, you'll see the calendar year returns, and you'll see in a year like 2018, they were down 7.6. The benchmark was down 11%. And then in 2019, you'll see in that same environment where there was a little bit more discernment around quality, they were up 29%. 2020, emblematic of the junk rally, they were up only 8.7 because your GameStops and your AMCs, that theater stock, they were through the roof. And then 2021, you'll see that they were basically double the index. 2022, they also provided significant downside protection. And then 2023, significantly above the benchmark. So, Fran, really good question there, because I think that really underscores the return stream that we expect from Copeland. And when the market is a little bit crazy, for lack of a better term, you can expect that dislocation like we saw in 2020. And it seems like a little bit of a repeat. 2024, we saw some downside relative to the benchmark, and we're also seeing the same year to date 2025. But at the beginning of the year, when there was a little bit of a sell-off, we actually saw Copeland hold up well versus the benchmark. So all in all, we still think it's prudent to monitor them, but their return stream, I think these numbers do underscore the type of return stream that you expect from a manager like this, really focused on quality, fundamentals, cash flows, and dividends.
You, Marquette included a newsletter from Copeland Review. It starts with the Pied Piper. It takes me everything following everything else. But anyway, I thought it was a good article. And I thought it reminded me of a little bit of the Benjamin Graham, Warren Buffett, where the stock market in the short term is a voting machine, but in the long term, fundamentals seem to be the most important thing. I know we've been saying that and waiting for that, but we were thinking in the long run that would be the case. So I think it's good to have some exposure to that in the larger portfolio in order to make sure that the fund is well diversified, and in the event, of course, at some point we see the markets reverse, and maybe a company will provide some downside protection there, and it's not just small or mid cap in that area. And you see the same thing for an ETF that has been valued as one of the best is the Schwab Dividend Equity Fund, which has been lagging the returns of the market. And I'm looking at it and I'm saying, why? It's a great fund, it's good stock, the history is great, but it's exactly what they're saying here. So it's not just small and big caps, even large caps in this area are not getting the returns that you see from the Palantir or these other stocks. Not that that's a bad company. Maybe Goldman's a great company, but not seeing the same returns. So I appreciate the review. The materials you provided were very helpful.
Thank you.
Don, Christy, any other questions on Copeland, or do you want us to cover the most recent performance?
No questions from me.
No questions.
Right, I'll dive right into the September flash report. Starting on page 4 with the return bar chart. So here we see that for the third quarter, the portfolio performance was slightly trending that of the policy benchmark with a return of 5.6. That brought year to date to 13%. So tracking error is the largest for the year to date period. And as Craig mentioned, a lot of that tracking is coming from Copeland. And we'll explore some of the additional drivers that are increasing that tracking here in the next few pages. But for the asset allocation, disclose the targets with cash serving as a proxy for fixed income. So although we are showing an underweight to fixed income currently, that's counteracted by the allocation that we have in cash. Cash is paid well still, so good proxy there for fixed income. And then the portfolio ended September with 734 million. 734.3 million in assets. And with that, we'll jump quickly to performance. And that begins on page 8 with your fixed income managers. So here we see that the fixed income managers are performing in line for the quarter. There is some outperformance coming on the year to date, where we see the composite of 60 basis points with a return of 6.8. So that is being driven by two managers in particular here. So Garcia and Hamilton, they have a return of 7.5, outperforming their benchmark by 180 basis points year to date. And then MetLife investment grade credit had a strong return of 8% for the year. So these two strategies help drive that outperformance at the positive. And then moving on to the next page here, page 9, for domestic equities. Brownline and Northern Trust indices are performing as expected, so no surprises there. Pine Bridge had a good quarter with an 8.6 return at 50 basis points of outperformance there. Year to date, Pine Bridge is lagging the benchmark a bit. So here, Pine Bridge is probably tail detracted with the large cap value style factor. The largest detractor explaining some of that tracking error we see here today. And obviously the biggest detractor, and Quick already covered a lot of it here, Copeland on your small cap composite. Frontline performing as expected, so nothing to report there. But Copeland has underperformed in the most recent year, and that performance is now creeping into that tracking error that we've seen earlier. So the story of it really is that the small cap benchmark is being driven by unprofitable companies. And the risk on momentum similar to what we've seen in 2020 that Quick mentioned earlier. So AMC is another example where hedge funds were shorting. Fundamentally, they were right, but retail investors kept pushing the stock price up, so they have to combine that. So there's some of that being seen in the market, just not to that same extent. Additionally, the easing of tariffs in April helps to further fuel that risk on momentum. Not to mention the rate cuts and further expected rate cuts. So just a risk on environment in full where fundamental managers aren't necessarily being rewarded. So the current market environment is not one that can reward strategies such as Copeland's, where you have strong fundamentals, sustainable cash flows, and growth. In the long term, as Fran mentioned, we do think that it will come around and correct the performance there. But with that, we will move over to the international managers. Here, pretty good for in line for the quarter and outperforming year to date by 60 basis points. The Canadian is trailing for the quarter as well as year to date. But again, Canadian's high quality till detracted for the quarter, and most of the traction came from their emerging market suite. And to a certain extent, what we're seeing here domestically, Canadian was hurt by a lack of exposure to faster momentum names that are outperforming within their index. So something that they're seeing, just not to the same extent here domestically. And then on the bright side, Earnest, strong outperformance here for the quarter as well as year to date. Year to date up over 140 basis points, and here Earnest was helped by the global rates of tech. And investments in Europe and Asia were also driving performance there. So all in all, quality tilts are hurting the portfolio at the moment, but since we are long-term investors, we expect everything to kind of be in work here. So no concerns, but as Craig mentioned, we will keep an eye. I can take any questions.
Just a general question. If we do see a return to obviously some funds, not particularly pro, just in general. That doesn't spell good news for the S&P or anything, just because they're so highly valued at this point, based on traditional value metrics. That, how much of a concern is it? Like for a portfolio that's exposed to equity?
No, it's definitely concerning. I mean, and a lot of this really, the Magnificent Seven, I know that it's been kind of hammered, but a lot of the performance drivers that we're seeing in these indices are very concentrated to the tech sector. So if there were to be a correction in fundamentals were to return, my guess is the breadth within the index will expand and you'll have companies that'll end up coming in, and it'll be more than just the seven. It'll be a broader set of names within the asset class. So obviously, having that correction come in will hurt with the current allocations within that index. But the belief is that there are good companies within that index that have strong fundamentals that are currently gaining.
In the code with newsletter, it's funny, I'm trying to remember what I saw. They have a bar graph or something they call the S&P 493, which I assume takes out the Magnificent Seven.
Yeah.
And it shows their return over time being much different than other areas. And they have areas for unprofitable U.S. small caps, unprofitable NASDAQ, profitable NASDAQ, and profitable small cap. Of course, the small, big profitable small cap. 5%. So a little bit of concern what happens to the wider indexes. If there was a return.
Yeah, no, I think there'll be a large drop in the short term, but over the long term, I do think those fundamental, both strong balance sheet companies will be able to step in and
Yes.
The only other thing I wanted to mention, total assets, even in spite of about $5.5 million of benefit payments, they have risen since the end of September. So we were at about $734 million at the end of September. We're now over $739 million as of this morning. That includes $16.6 million in cash. So 5 to 6 months of benefit payments, and we have taken the opportunity when it's appropriate, the high equity valuations to raise a little bit more cash for future benefit payments in the event of market correction or fundamentals returning. So I just wanted to add that. And then also note our next meeting is scheduled for January 14th.
Great stuff. Alberto earlier mentioned cash as a small proxy for fixed income. At what interest rate does that become a non-viable solution? I'm not saying when we get to the first of all, but at what interest rate do you think it becomes a non-viable solution? The substitute, not whether or not it's a good idea.
I don't want to give a lawyerly answer, but I think it depends on what specifically in fixed income you want to compare to cash. Do you want to compare just the normal Barclays like ag?
Whatever Alberto was comparing to, I don't think it's.
yeah, no, we were looking at the yield. So I think 4% currently.
Yeah,
Yeah, and it is going to drop, especially with the expected rate cut. So that's a great question. I'm not sure if there is a certain cutoff, but I will definitely tag you quick on this one. Sorry, but would you be able to speak on this for a little bit?
Yeah, absolutely. So I would say that once we start creeping towards, or I should say below 3%, from a net or real return standpoint, I think that's where we could say, okay, it's back to cash just being cash. But right now, at the 4-ish, high 3% range where we expect things to settle from an interest rate standpoint, we can still consider that to be a pretty good proxy, more so on the intermediate side, as Chris mentioned. So the ag will have a little bit more uptick as rates are coming down than your cash would. But ultimately, again, as long as we're in that 4 to 3 range, still a good proxy for fixed income. And then as we start creeping towards that 2%, from a real return standpoint, you're basically not getting anything. So that's where we revisit the assumption that cash is a proxy for fixed income. So we're not there yet, and it doesn't seem likely until 2026. There will be a new Fed chairperson, probably not as objective as this one. So that's something that we would revisit based off the Fed's policy when the new chairperson comes in.
And Quaker, I think we also have to also consider just the safety, aspect of having the cash. So not necessarily needing to raise money during a really down period, right? So we have to
Absolutely.
To Fran's point, the interest rate obviously is no doubt important from a asset allocation standpoint. But we also have to balance that with, if the market does have a sudden, let's just say 10 or 15% correction, at least during those initial months, we wouldn't have to raise cash or equities. And that would give us some buffer to hopefully start to see at least a bit of a recovery. So it's a balancing act. You're no doubt right about the interest rate.
Agreed.
We're trying to those two objectives.
So you don't want to realize the loss.
Right. So we're trying to straddle those two things. But your point is well taken. I mean, there is a point where it's probably not appropriate to consider a full fixed income substitute at a certain interest rate. I think that's fair.
Is there any concern about the direction that the Supreme Court may go as it relates to President's authority tariffs? Until they make a decision on this in January, February 26th.
So I would, this is speculation. Quaker or Alberta may disagree with me. I would think that if the Supreme Court largely struck down the tariffs, the market would take that as a positive. Because I think the markets generally have not liked, we've seen when the tariffs were first implemented, the market reacted very negatively. Now, it has held up better than expected. I think the wild card for me anyway in the Supreme Court's decision is at least one or two of the justices strongly hinted that even if they found the president to lack the authority under the statutes that he's used, that there may well be other statutes he could rely on to keep most of the tariffs in place. I think if that were to happen, the market may not react positively or negatively just because we'll kind of be in a status quo situation. If the Supreme Court, however, were to find him to have essentially unfederal authority in this area, I think the market would have a negative reaction. If they were to basically say anything can be declared an emergency and there is no limit, I think the market probably would have a negative reaction to that. I don't know if Alberta or Quake would feel otherwise, but that's kind of my reading of the tea leaves.
No, yeah, I agree. The main part was once they were introduced, market had that negative reaction. So tariffs are things companies don't really like to pay. So that I think will align with what Chris mentioned there.
And I would agree with that as well.
Yeah, I think that's fair.
So the economy in general, and macro economic standpoint, it would be a concern. Because of such many things. You see how people's ability to eat and survive. So dynamics are certainly have an effect on the macro economic situation.
Yeah, again, it's always speculation, and you can never fully predict a decision based on the question. But it seemed that, let's say, the justices who are going to have the most pivotal swing votes, perhaps Justice Roberts, Chief Justice Roberts, Justice Barrett, maybe Justice Kavanaugh, seem to be searching for some sort of middle ground, recognizing they didn't want to intrude too much on the president's core foreign powers under, prerogative under the Constitution, but also recognizing, I think one of the questions, which was somewhat telling, was asking the president's lawyer if a future administration could enact like a 50% carbon tax and say that climate was an emergency. And the president's lawyer said yes, which I think the question there, you could infer a little bit that perhaps the justice asking it wasn't necessarily comfortable with that level of expansive reading. But again, I think it was Justice Alito did strongly kind of state that he thought the tariffs could probably be upheld, many of them on other authorizations, other congressional statutes. So it did seem like, I'll call the center of the court was grasping for some middle ground. But again, that's just trying to predict the unpredictable. Christie or Bill, any other questions either of you had?
No.
So are you suggesting that we could adjourn? Is it motion to adjourn?
You're suggesting that I'm in, Don, so second that much.
Thank you all.
Thank you. Thanks,
Thank
Christie.
you.
Thank you.
Bye-bye.
Thank you,
Thanks,
Don.
Christie.
Good seeing you.
You too.
To have fun.
Yeah.